Okay, now this is the video I want to make. I'm sure you don't give a crap about it. I'm going to take the video we just made. If you watched it, fine. If you didn't watch it, even better, where we went through the basic kind of model. I emphasized the getting a consistent timeline, blah, blah, blah. And we just had one dead issue, and we did a copy and paste, and went included political risk insurance, withholding fees, commitment fees, upfront fees, okay, and a debt service reserve account. All right. Now I'm going to show you this in this video how to put the UDF option in here and show you how you can kind of if you want to change something around. Let's change the construction period to 40. And let's change I don't know, the capital expenditures to 25,000 or something. And okay, and change whatever, the interest rates, whatever. Now we have a difference and we have to do this. And it's not really very quick, actually. It might not be so quick after we add some more things and completely build our model out and everything else. But I want to show you how you can put the UDF or the parallel model or whatever in this part of your model and demonstrate how you can reconcile everything. So please, the clock is not ticking yet, and I'm not going to put pressure on myself this time. So here's the way you do it. You go and you get a template model, and then you connect selected items from the model, things like the capital expenditures, and I hope I have some EBITDA up here, and some things like interest rates and debt to capital percentages. Basically, everything you really need to run this model is going to be in a little input sheet. Or perhaps better a transition sheet. Okay, and so I'm going to do it. Now, my suggestion on this to make it easy, and my idea here is to have you not think this is to say it's not a black box would be bullshit. For you, it might be a black box, but we're going to prove that if we prove that it gives you exactly the same numbers as this one, then the mystery of the black box should be taken away, and I've got a mistake in here. I'm not telling you about this mistake, and this mistake will be caught by the UDF, and we can modify the UDF, and I want to show you that that's really kind of okay, and start taking some of the black box elements out of this. Now, to do this, I would suggest, instead of copying the template model into your file, I suggest you take these two sheets and you press Alt-EM. And then you go to move a sheet. And you go to this thing called the UDF template. And I'm going to even create a copy and put it in here. So now we have our exercise, and this could be 100 sheets or 20 sheets or however. And you put some, then at the very end, you put this this thing called UDF. Maybe I should call it parallel model transition or something like that. I think I'm going to change the name. Okay. Okay. Now we're going to do it in a simple case first, and we basically have to fill in these few inputs. Now this time we only have we don't have 3 dead issues. We only have 1 dead issue, so we have to fill in a few items from our model. And this time, instead of its named template, so I'm going to save it as our model exercise with UDF. Okay, and then let's just start working through it. So this is going to be a very mechanical thing, but it's going to show you, hopefully, that putting the UDF is not really, if I'm, and this has been my desire for way too much time, it's not that hard. Now let's first make EIS and go to 150, just like we did, okay? And then let's just copy the dates in, and that's why I kept on emphasizing a consistent set of dates. So I'm gonna just, actually, why don't we do it like this? Why don't I just okay, you see, I'm not, this time pressure is not on me. Okay, I just want to show you that it's not that bad to do. And Shift Control R and then Shift Control R. Okay, and then we put in, I'm going to leave the development period as 1. That's just something I had to have. And then I'm going to put in that was a bullshit thing. Then I'm going to put my construction period in. And then I'm going to put my operating period in. Okay, maybe you don't have these things. I just can't believe that you can make them all without them. But I've seen people do it. And then I'm going to go into I'm going to go to the exercise and go down to the sources and uses of funds statement, somewhere the period by period. And I'm going to first put in our development costs, and then I'm going to put in our construction costs. Of course, this is just cash costs. It could be anything you want, and I'm going to copy it across. Okay, and then I'm going to get the EBITDA, which I don't really even need actually right now. But I'm so used to putting it in, and that you need that for the sculpting analysis, and then some working capital change you can put in, depreciation. I'm not putting any of those things in because those really are driven by they're driven by the sculpting. You need them from sculpting, and then we'll go upstairs maybe to some of the inputs. It's best if you can take them from the inputs, and then I'm going to put a debt sizing method. And I'm going to make this debt to capital. Okay, I'm going to make sure that that's okay. I hope that I did that. And I just did something stupid already. Okay, this was the upfront equity percent. And this now for the sizing, that's our debt to capital percent. Now we could put a fixed debt amount in, or this is for the much more difficult and much more important part to drive it by sculpting. But I'm just going to keep it on debt to capital here. And then we can put a shareholder loan in, but I'm not going to do that right now. And we can put in a development fee and some initial working capital and an operating reserve account. And I'm not going to do any of that. I better absolutely make sure that that's zeroed out. Okay, and then we can put our withholding tax rate in. And again, that's just from our assumptions. Each of these, and I hope oh no, I didn't do it like this. Excuse me for that. Okay, and then if I have some fixed fees after the COD, we can put those in. That's again for the sculpting. And then for the DSRA, I hope that our exercise right now has just one period. And this time, maybe this is going to be a tiny little bit different because I just want this stated in terms of periods. This is how many periods to look forward to. Now, if the DSRA is funded, we put false in here, I believe. That's just horrible. It should say DSRA funded F versus LC true. I can't put true and false in there because it whatever. It colors it inappropriately. Okay, and then let's put this is the letter of credit fee if you have any on a DSRA, and then we put how much the equity is insured. Now, why don't I just take that here? No problem taking it here. And then it says the periodic equity risk premium. Okay. And we go to Shift Control R. Okay. That's that. And I don't have any fixed fees on the debt going forward. I thought I might have put that somewhere else, but whatever. And there's this whole business of fees going forward drives me completely crazy. Now we're going to make our total debt here 100%. We could put the amount of the debt in instead of the percent. We'll talk about all that in the next section. And then we put our periodic rate for the interest rate in. Now, I just hate it when people have one interest rate in one sheet, another interest rate in another sheet, and that's why I moan about it. And I know that's what you're going to have to do. So this, in reality, it's because of that reason. In reality, it's going to take you a little bit longer. And then the commitment fee, the same sort of thing. You should have somewhere a periodic commitment fee here. Okay, and then somewhere we also have a upfront fee. So we're just kind of going through, and these are so standard in the models, really, aren't they? I think they are. And then we have some risk insurance on our debt, some political risk insurance, which, whether that should be considered part of the regular interest or whatever. For me, that's a why you wouldn't call this interest, but people call this insurance. People, and the insurance expense has a different effect on the CFADS and all that. So I have to go down and find this. And here's the rate, the periodic rate again. Okay, and then we could sculpt, but I'm not going to. And instead of sculpting, I'm going to put in I hope I did this. I perhaps didn't. This is very bad. I didn't do this. So there's one input we're going to have to kind of make a little adjustment for. And I'm going to put down here, insert a line, Shift Control R, and I'm going to put the repayment percent. Just a percent if I want to put it per period. And this is an amount. And we can take our total amount of the repayment and take our debt repayment from this line and just divide that by this total amount up here. Shift Control R. And then I'm going to put that repayment into the model. And now this is really what the whole sculpting, Shift Control P, Shift Control R, this is what the whole sculpting business is all about. And guess what? That's finished. It was not that bad. I'm going to press Shift Control C again. Control Alt C, excuse me. And just show you kind of what came from our model. Now, of course, the first time you do this, it's going to be more painful. And now I hope you can see which numbers. Oh my God, I didn't color the top. Why not? Okay. I think I did that after. Oh, okay. Whatever. God damn. That's it. So these other debt issues are ignored for now, and you can add as many as you want, and there's blah blah blah. Now, let's maybe we should put this as our financial model. Now, this is not going to work exactly. I know why, because I kind of cheated, practiced once, and when I was getting my whatever car, the oil changed. I shouldn't have a car. It's old. And then I'm going to put in some of these things from the parallel model now. What I do up here is go up, and the parallel model does a whole little model for you. Now, I think I'm going to just take these ones from the computed. Okay, these first two. I could have taken them from the parallel model, but it didn't really matter. And then I'm going to go through to the parallel model and find my interest during construction. which is right here. Now then I get really sad because it's not exactly the same. And I kind of know oops, shift control R. Oops, I meant to press. No, what a stupid thing. Then I'm going to go to and find the withholding tax. And the withholding tax on IDC and financing costs. That's different. Shift control C. I better put shift control C on all of these. Oops. Okay, and then I'm going to get my upfront fees. And you just go step by step. And I really should be taking this one over here that says debt size. And where are my upfront fees? Not on mezzanine debt. Upfront fees on senior debt. Right there. And that looks pretty close. And then don't worry about it not being exact. Upfront fees, then commitment fees. Again, from the debt sizing one. And then I put my political, oops, I go to this one and find my political risk insurance on debt. And then I put my political risk insurance on the equity. And then I put my debt service reserve account in there. And then we can add them all up, I guess, and it doesn't work. But the big one that's really different here is the withholding tax. And the problem is I made a mistake in the model. I made a mistake in the model because when I computed withholding tax here, whoops, I computed it just on interest. And that's really stupid. Because then all the bank would have to say is, we're going to just increase our fees, reduce our interest rate. It's all the same. And we're going to get lower withholding tax. And the government, you might like that, but the government would be able to see through that and say, no, this withholding tax is on interest and fees. So I'm going to put some total interest, and then we're going to put our total commitment fee. How about I can spell upfront fee easier, and total commitment fee, and then I can call that my withholding tax base. And then I can compute it. Now, instead of doing that right now, let's kind of cheat. So I practiced, of course, and saw that this was the answer. So I'm going to take this withholding tax that hopefully I put up here, and I'm going to put a 0 in it temporarily. And then I didn't put the PRIN for some reason, and let me get that again. Is that this one? No, it's, sorry about that. It's this one. And we have a tiny little bit of a difference. Now what I have to do is actually, this is correct. I took the withholding tax out, so we'd have to rerun the button. Now, if I right-click on this button and assign the macro, I've got a problem. And oh no, oh no. Sorry for the interruption.
Bonjour.
God damn it. Stay quiet, I'm making a video.
Bonjour, ça va?
Non, tu ne peux pas parler français.
Oui.
Oh, shit.
Oui, tu parles français.
All right. Stupid interruption. Okay, now I got to get my train of thought. Now, what I should have done is when I copied this file, okay, or this file, remember when we copied this at the beginning, I forgot to separately copy the macros. So I have to, so I copied this one in. Now I still have it set to the copy paste, not the UDF. So I do this. And now you can say it's taking a little longer. You can say, well, that's because you put the UDF in there, and maybe you'd be right. And now we get exactly the same result. Now, if I put this over here, come on. So now the applied is equal to the copy paste, and now I can just change things. But I'm not quite ready, of course, because I have to also. So let's change this back to 36. And now what happened is the whole UDF changed correctly. It did, I hope. No, well, I better finish it off because we're going to have to put the copy and paste into here. And what I'm going to have to do is got a stupid little call right now, so I'm going to have to stop this. But I'm continuing with my video. Okay, I'm just going to talk into him. I stopped in the middle here and I added some things. If you noticed, perhaps there was an embarrassing little circular reference that just appeared just before I've made my restart. And let me tell you about that. When you put some of these things that you put in the mold, and in particular this repayment percent, that cannot come from the that cannot come from the formula that depends on the level of debt, because the level of debt has some circular reference. What kind of crap is that? So I made that change, and then I made another change. And the other change is I simply put, just almost in the same way that we put the UDF, the computed, the UDF, and the copy and paste here, I put three formulas. The funding needs, which causes the circular reference, and that can just be fixed. Or you notice that can come from the parallel model. So in the parallel model, you just go downstairs and you find just about any number that you're going to use. Here are the funding needs. Shift Control R to copy them across, and then you can do the same thing. There was a little switch up here that said we're either going to use the circular, the UDF, which is true, or the circular reference. And you notice now they, as in the other table, they give you exactly the same result. Now if you're irritated by the music, I'm sorry. My father's here and I'm trying to get him to listen to a little music, which is kind of nice. Okay, sorry. So that's that. Now that all worked without the withholding tax. And as I said before, what I had done, now I've done a little work on the withholding tax because I've been getting screamed at because I work too much on Excel, and my life has no meaning except stupid little Excel models. So before, when I did this, that's why I just stopped the video. So if you give a crap about that. I got this weird email too. This email that says, I was delighted to watch your video. Do not or never worry about language. I work in construction. Do not have the correct blah blah blah. But I can make roads. Good for that's what a nice little message. I don't know really what that meant. Well, okay. And then so we're going to put back to this. We're going to put in a little withholding tax. Now, right now, I have withholding tax in the UDF, but I have no withholding tax in the model. So if I'm going to, I almost don't have to switch this, but if I switch this to the copy and paste, press the button, there's nothing. There's nothing. I copied the computed, and I have nothing in the computed. If I go down and find that, there's nothing there. Now before, I just took the interest and computed the withholding taxes on the interest. And then I said, well, it's pre-COD, so we put the pre-COD flag in. And what I'm trying to really show you here is what to do if there's a little bit of a difference. And then we can, of course, do the same thing for the post-COD, although I'm a little bit reluctant to do that because because there's a mistake. And now when we put this into our model, number one, there's some withholding tax, I hope, over here in the period by period sources and uses of funds. And more importantly, there's some with here, and we have a difference. And if I make the copy and paste, now we have a little bit of a difference. And the question is, who was right? Now, what we can do is if you go to the parallel model, there's a little thing that says go to function. You have to right-click on this. And if you press assign macro and press edit, and then you can do a find. Withholding. And the withholding, that's part of the project cost. And then I have a whole little function called withholding. And if I want to find that, I press Control F. So each of these little calculations is in a separate little function. But down here it says, so it's not hopefully that difficult to find. And it says the withholding tax is computed from fees, commitment fees, upfront fees, and we get a total withholding base. Now, maybe the withholding is also, watch out, don't spill your beer. I gave him a beer. Are you enjoying my video?
Yeah.
Okay, good. I didn't mean the thing on the TV. Nothing, it's okay. And then here you could also include the shareholder loan interest, maybe not. You could include the IDC on the VAT. So you can see how the calculation is made. That's the point. And you can change this calculation. But here I just left it so you could put ×1 to kind of include it. It's very much like in Excel. And then you compute the withholding base, and then you multiply that by the withholding tax rate. And the withholding tax rate is 1 divided by the 1 minus the withholding rate, and all of that. It's kind of a little bit, could have been easier, I suppose. And that's the total withholding that you then put into the source and uses of funds. So right now, instead of changing it in the UDF, which would be very easy, I'm changing it in the model because I believe, it's pretty obvious that you could choose to have only commitment fees and upfront fees instead of interest. The bank doesn't really care how they get their money. So now I'm going to change this and put this on the total withholding base. And I've got some withholding tax. And then I'm going to do the same thing up here. And this illustrates sometimes you could go and change the UDF. And the UDF is very much like the model itself, I hope. We put the different interest in here and multiplied it by the fees. I could have actually been a little more elegant, I realize, with that withholding fee calculation. And now we've got the same thing. And if I press the copy paste button, it's all the same. And if I use the UDF, now I can go and change things. What am I going to change? The standard deviation. Let's make the standard deviation 0.6 for some reason. Now, if I go down to our thing, we'd have to, each time we change that, run the copy and paste button. Actually, since the UDF is on, the copy and paste button works more quickly. Okay, and that's that. That's that. Excuse me for the phone call. Get it yelled at for doing too much Excel again. And I'm going to stop here. Now I'm going to make a second video that shows more issues with the pre-COD part of this analysis. And I really, really, really hope that I've shown you that it's really not that bad to do. It's not that much more difficult than working through a copy and paste. Although I certainly think that you should present both. And oh, I'm stuttering a little bit now. I also would like to explain to you that some of the complicated issues, like all the sculpting business gets far more complicated, and it's really a pain to work through in a model, and the copy and pastes get to be quite slow with all of that. So I'm going to illustrate this. In this case, maybe you could, and you would probably be correct, and I'm trying to be objective as I possibly can here. You'd probably be correct that there's the copy paste versus the UDF, not a big deal here. But once you get into more complicated sculpting, once you get into P50, P90, once you get into different debt sizing techniques, which all involve really the post-COD period, then things can get painful. And then the copy and paste can really slow you down, so you can't kind of do these quickly. Now I'm putting the UDF template on the disk. I've given up. People say I should have a patent on this or something, and whatever. I just want people to use it. I want people to call me and say, I need a course to do this. I need to get really, really comfortable with changing little things, like I showed you with the withholding tax. Okay? Maybe you'll never do that, and maybe my life will just be a miserable Excel life, but whatever. I made an Excel Christmas card anyway. Okay, that's enough of this one. Next ones will be a little more complicated funding issues. Okay, I stopped the video, but I really have to make another addendum to this video. Because while I was creating, in the earlier video when I was creating the model, I had some discussion about the horrible DSRA account. And in this DSRA account, I said, okay, well, we're going to use this offset function to look ahead. And if it's one period, that's pretty easy. You just look ahead. But if it's two periods, you have to go here. And if it's two periods here, you have to go backwards. And I said, okay, but we only want to fund this right in the period before construction, COD rather, and then we'll figure out how much we need, and then we'll put this, either allocate this during the construction period or the post-construction period, and our closing balance goes to zero, and we're all happy about all of that stuff. And the DSRA, at least during the construction period and with a very simple kind of repayment structure, is all modeled. Okay, actually, that's about it, unless you have a automatic, kind of a withdrawal, and if there's deficient cash flow later on, blah blah blah. Okay, now the real test of this whole thing is what happens if did I model this correctly and consistently, and what happens if I put 18 months in here? Now, if I put 18 months in here, what happened is, the good news, the UDF went up. Now, of course, the computed also went up, but it's not equaling, and that's because of all the circular reference. So now we have to do another little copy and paste. Didn't take very long, so I understand. Okay, it's not that bad, blah, blah, blah. And now we get the same result. That's good news. And if we go down to our model, uh, we'd in the model, we'd see that there's only the DSRA funding here occurs in this period, and these two periods are kind of nice to have, but they're just not really relevant. The funding requirement is this one, and we multiplied that by this by the switch to turn it off, and then we have the closing balance left over. Are you reading the paper? And then once we put that in, but look at the parallel model. This is what's so exciting. The parallel model has the same number, no big deal, and that's the wrong number I'm looking at. We have to go down here and find the DSRA funding during construction. Here's the total amount, and it's included as part of the debt sizing. And we go across, and oof, das ist tough. It's right there. It's right there, and there's none of these earlier stuff mucking up the whole thing. And we get the total funding correct. And we can, of course, look up here to our little red and green thing, and the funding is okay. Okay, and that's the kind of stuff you can do. Now, I'm not going to take you to the UDF model and show you exactly where the DSRA is calculated, because I have to clean it up a little bit. But just as we did the withholding taxes, we can look at the formulas, isolate those formulas, and see if there's going to be a problem if you have to adjust it a little bit. Hopefully, there aren't too many problems. There might be some, but hopefully not too many. So this is my second time I'm stopping the video.